Many retired silver investors believe they found a way to avoid taxes forever. They think because American silver eagles are official U.S. coins, carry a $1 face value, and are backed by the government, the IRS cannot touch their profits. But this belief could create a serious problem. The shocking truth is that many people are not getting in trouble because they tried to break the law. They are getting into trouble because they trusted information that sounded logical, but was completely misunderstood. A lot of silver owners believe this: if my dealer does not send me a tax form, then the IRS never knows about the sale, and I do not have to report anything. That sounds reasonable, but under the tax rules, there is a major difference between a transaction that is not automatically reported and a transaction that is not taxable. And that difference is where many retirees could make a very expensive mistake. In this video, we are going to break down the truth behind the American Silver Eagle tax myth. You will learn why these coins create so much confusion, what the reporting rules actually mean, and why a missing form does not automatically mean your tax responsibility disappears. We will also look at a legal strategy that many long-term silver holders may want to understand before making their next move. Before we continue, remember this video is for educational purposes only. I am not a CPA, tax lawyer, or financial advisor. Always confirm your own situation with a qualified professional. Now let's uncover where this silver tax myth actually started. The American Silver Eagle is one of the most recognized precious metals products in the world. It is produced by the United States Mint. It carries an official government-backed status, and because of that, many people assume it should be treated exactly like regular money. That is where the confusion begins. People think, if the government created this coin, how can the government tax me when I sell it? It feels like common sense. But the tax system does not look at silver the same way most people think about everyday currency. For investment purposes, physical silver is treated differently. And understanding that difference could save silver owners from a major financial surprise later. Because the biggest mistake is not selling silver. The biggest mistake is believing a myth and making decisions based on incomplete information. Here is where things become confusing for many silver owners. There is a real IRS reporting rule that people often misunderstand. When you sell certain precious metals to a dealer, the dealer may have reporting requirements. In some situations, the dealer must send information to the IRS through a form called 1099-V. This form creates a record of the transaction. Many people compare it to selling stocks through a brokerage account, where the company reports the sale automatically. But American Silver Eagles are treated differently when it comes to dealer reporting. For certain Silver Eagle transactions, a dealer may not be required to automatically file a 1099-B form. And this is exactly where the myth begins. Someone sells their Silver Eagles. The dealer does not send them a tax form. Tax season arrives. Nothing appears in their mailbox. So they assume no paperwork means no tax. But that assumption is the mistake. The absence of a 1099-B does not mean the IRS has declared the sale tax-free. It does not mean the profit disappears. And it does not mean the seller has no responsibility. It only means one specific thing. The dealer may not have an automatic reporting requirement. Your own tax responsibility is a separate issue. This is the part many people misunderstand. A reporting exemption is not the same thing as a tax exemption. Those two things sound similar, but legally they are completely different. Think about it this way: if a company does not report a transaction for you, that does not automatically remove your responsibility to report income or gains that apply to you. The IRS rules are focused on the actual financial gain. So if someone bought silver years ago at a lower price and later sells it for much more, the increase in value may create a taxable capital gain. The question is not, did someone send a form? The real question is, did you make a profit? That difference is what every silver investor needs to understand before selling. Because many people are not worried about taxes until the day they receive an unexpected letter or face questions about a transaction they thought was completely invisible. And by then, the situation can become much more stressful. Now let's talk about the part that many silver owners do not think about until it is too late. The actual tax responsibility. When physical silver is held as an investment and later sold for a profit, that profit can be treated as a capital gain. This means the difference between what you paid and what you receive when you sell can become important. For example, imagine someone bought American Silver Eagles years ago when silver prices were much lower. Over time, the value increased. Then one day, they decide to sell their collection. The dealer pays them much more than their original purchase price. That increase in value is not simply ignored because the dealer did not send a form. The profit itself is what matters. This is where many investors get surprised. They focus on the paperwork instead of the actual transaction. They think, number 1099B. No problem. But the tax rules do not work that way. A missing form does not erase a financial gain. If there is a taxable gain, the seller may still have a responsibility to report it. And because physical precious metals can fall under collectible rules, the tax treatment can be different from many traditional investments like stocks. That difference is important. Many people assume silver is just like any other investment, but the IRS views physical metals differently. Now, what happens if someone ignores the sale because they believed the myth? This is where the situation can become serious. If the IRS later discovers an unreported taxable gain, the person could potentially face more than just the original tax amount. There could be additional penalties. There could be interest charges that continue building over time. And a problem that started from simple misunderstanding can become much more expensive years later. The most important thing to understand is this: the IRS does not only look at whether a company reported something. They look at whether a taxpayer followed the rules that apply to them. A person may honestly believe they did nothing wrong because they heard the wrong information. But the tax system is based on the actual rules, not on what someone at a coin shop, online forum, or social media video claimed. That is why understanding the difference between facts and myths is so important. The goal is not to create fear. The goal is to make sure silver owners know what questions to ask before making a major financial decision, because a few minutes of research today can prevent a major surprise in the future. Now let's look at something many long-term silver owners may find surprising. This video is not only about the risks. There is also a legal estate planning concept that many investors may want to understand. It is called a step-up in basis. This is a tax rule that can become important when assets are passed to heirs. Here is the basic idea. Imagine someone purchased American Silver Eagles many years ago. At the time, silver was much cheaper. Maybe they bought their coins when silver was around $15 per ounce. Years later, the value increased significantly. If they sell those coins during their lifetime, the difference between their original cost and the selling price could create a taxable gain. But inheritance works differently. When assets are passed on after someone's death, the cost basis may be adjusted to the fair market value at that time. This means the original purchase price from decades earlier may no longer be the number used for calculating future gains. Let's make this simple. Imagine a silver investor bought a collection many years ago for a much lower price. Over time, the collection became worth much more. If the owner sells it themselves, the increase in value may be considered a gain. But if the owner keeps the silver and it passes to their heirs, the value may be adjusted based on the market value at the time of inheritance. For the heirs, this can dramatically change the tax situation. If they sell soon after receiving the inherited silver, there may be little or no taxable gain because the new basis reflects the updated value. This is why estate planning matters for precious metals investors. Sometimes the biggest financial decision is not just, should I sell? The better question might be, what is the most efficient way to transfer this asset? Many people spend years building a silver collection. They think about protecting wealth, preserving value, and passing something meaningful to their family. Understanding how inheritance rules work can be just as important as understanding the price of silver itself. But remember, every person's situation is different. Estate laws, tax rules, and financial circumstances can vary. A qualified tax professional or estate planner can help determine what strategy actually fits your situation. The key lesson is simple. Do not make a major decision based on rumors. Know the difference between a tax rule, a reporting rule, and an investment strategy, because that difference could affect thousands of dollars. So now let's bring everything together. The biggest mistake silver owners can make is confusing a reporting rule with a tax rule. American Silver Eagles may have special reporting situations, but that does not automatically mean every sale is tax-free. The fact that a dealer does not send a form does not erase the responsibility that may come with a profitable sale. The real question is not, did someone report my transaction? The real question is, did I create a taxable gain? That one difference can completely change how you look at your silver investment. Many retirees spent years collecting silver because they wanted security, protection, and a way to preserve wealth. The last thing they expect is a tax surprise caused by bad information. That is why understanding the rules before selling is so important. Before you sell your silver, know what you own, understand how it is treated, and get advice that matches your personal situation. Because the difference between a smart decision and an expensive mistake can sometimes come down to one simple misunderstanding. A tax-free myth can sound convincing, but facts matter more than rumors. If you own American Silver Eagles, I want to hear from you. Did you ever believe that Silver Eagles were completely tax-free because there was number 1099B form? Comment yes or nitrogen monoxide below. And if someone you know owns precious metals, share this video with them. A few minutes of information today could help someone avoid a major financial problem in the future. Stay informed, protect your assets, and always verify before you make a big move.